What if I told you that one single candle could completely change your trading life? I'm not talking about scented candles here. I mean candlestick charts. Each candle has a story to tell, and once you learn to read them, they can reveal where the price might be headed. So let's start with a powerful concept at the heart of it all. Liquidity. Liquidity is the fuel that makes markets move, allowing big players like hedge funds and banks to enter and exit positions without causing chaos. But here's the catch. These big guys don't trade like you and I. When they want to buy or sell, they need a lot of liquidity to fill their trades. And here's how they make it happen. Unlike us retail traders, big institutions deal with massive sums of money. If they want to buy, they can't just click buy without pushing the price up. So they find ways to create liquidity, usually by driving prices down first, so they can scoop up the assets they want at a discount. One way they create this liquidity is by releasing scary news stories to shake out nervous investors. Remember that recent Apple scare? Apple's stock dropped nearly 20% after a big, ominous press release. But guess what? A month later, Apple bought back $110 billion worth of its own stock, the largest share buyback in US history. Coincidence? Doubtful. Apple used that scare to buy shares at a bargain. Big firms also create liquidity by targeting retail traders' stop losses. They know where we're likely to place those stops, and they'll push the price just enough to hit them, triggering a flood of sell orders. This creates the liquidity they need. But here's the good news. You can use this tactic to your own advantage. Let's walk through how. Step 1. Set up your chart. Start by opening TradingView and setting it to the daily time frame. Look for the market bias. If it's bullish, you'll look to buy below the open. If bearish, you'll look to sell above it. Simple enough, right? Now mark the open and close of the latest daily candle. This sets up the boundaries of where you'll be looking for liquidity zones. Switch to a smaller time frame and watch for price to dip below the day's open in a bullish setup, or above it if bearish. This dip shows sell-side liquidity, a perfect setup for a reversal. Step 2. Confirm the reversal. To catch that reversal, mark the last high or low before the liquidity grab as your break of structure. Wait for the price to cross back over this line. It's your confirmation that the market is ready to change direction. Step 3. Enter on a fair value gap. Find a fair value gap, an area where price moved quickly, leaving an imbalance. Mark this gap, and once the price returns to it, enter your trade here. Set your stop loss below the recent low, and your take profit at the original candle close you marked. This setup gives you an excellent risk-to-reward ratio, risking just a little for potentially big gains. Let's try this with a bearish example. Mark the daily open and close, look for a break above to create sell-side liquidity, confirm with a break of structure, and enter on a fair value gap as price retraces. Set your stop above the daily open and take profit at the close. And there you go. A simple, powerful strategy that uses liquidity like the pros. With practice, you can spot these moves and get a better handle on when to enter and exit trades. Try it out, and let me know how it goes. Thanks for watching, and if you found this useful, don't forget to like, subscribe, and leave a comment.